In the case of silver and gold, but it's probably more pertinent in silver in a sense. You've got 1.5 billion Indians, you've got 1.5 billion Chinese. It's 3 billion souls. But you can see that the scale of potential demand here is just so enormous. It's not surprising. There's none left over. So don't be late at the party. If you're getting out of credit, I think that what we've seen is we have seen the banks, the big investment banks, actually realize this, though they won't admit it, are moving in that direction. I mean, they're making forecasts for gold. Goldman Sachs saying $5,500 at the end of this year. I mean, that's like saying Goldman Sachs is saying it's going up.
China and India are driving a massive structural shift toward physical gold and silver, driven by investment demand, industrial needs, and de-dollarization strategies. Silver enjoyed an even more spectacular rally than gold in 2025, surging roughly 145%, thanks to robust industrial demand from solar panels, electronics, and electric vehicles, combined with investment buying. Veteran investor and celebrated stockbroker Alasdair Macleod underscores that Chinese banks are increasingly restricting access to physical gold, with limited supply selling out almost instantly due to overwhelming demand. He explains that a large portion of China's massive household savings is quietly flowing into gold accumulation plans offered by banks. The demand from China and countries like India is so large that available gold and silver are effectively pre-claimed, leaving little excess supply. He suggests that price movements in futures markets are largely noise compared to this underlying demand, and warns that investors may struggle to access physical metal as shortages intensify. Moving forward, Macleod says that claims about Turkey selling gold are largely misunderstood. He explains that much of the gold movement in Turkey is actually internal, involving commercial banks and the central bank rather than outright sales into global markets. Macleod further expresses that unlike Western systems, Turkey's structure may actually be more transparent. There is no real evidence that Turkey is dumping gold internationally to support its currency, and such claims are misleading. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from Alasdair Macleod's recent interview.
Turkey is different from anywhere else. The idea that the Turkish central bank has been selling gold is actually wrong. The whole of the gold scene in Turkey was a bit of a mystery. And some time ago, when I was in Istanbul at a conference, I spoke to some bankers about this, and I asked them to explain it to me. I can't remember the details too much, but I think very, very briefly, what happens is that the commercial banks have a lot of customers who own gold, and they store that gold with the banks. And that, if you like, works almost like an unallocated gold account, whatever. They take that gold and they deposit it in the central bank's vaults. The central bank returns that as if it was own gold. And it probably is in the sense in that it is probably leased to the central bank for whatever reason against Turkish lira. So you've got swaps going on all the time. And so all you're seeing really is, and this is the difference between the way we account in the West, all you're seeing is the ebb and flow of gold between the commercial sector and the central bank. This is not gold which is going on to the international market because, the Turks are trying to support the lira. I mean, I haven't seen them do anything really to support the lira. I mean, it's one of the worst currencies in the world. I mean, how do you explain a currency which goes down all the time, and yet they continue to accumulate gold, or appear to continue to accumulate gold, and then suddenly they turn around and want to support the currency by selling gold? Come on, this is nonsense, complete nonsense. So, I mean, I thought that's the first thing. Don't be confused by this. Now, what we do in the West is, if, let us say, a central bank leases gold into the market, it records it still as its own gold. It doesn't record the leasing, but somebody else will record the leased gold as their own property, which, of course, it is in law. If you lease gold, it becomes your property during the duration of the lease. So you get double counting. You could almost say that the Turks they do it a bit differently, probably slightly more honestly than we do, in fact. So all this stuff about selling gold in order to whatever, is actually nonsense. They will keep control over it. I mean, it's as simple as that. It hasn't come onto the international market. So I think that's the first thing. The Chinese banks are now heavily restricting the availability of physical gold to their customers. I mean, the reports are that they've limited it to something like 600 kilograms, I think, something like that. I mean, there is a severe restriction, and it's sold out within a minute of 9 o'clock in the morning. Bear in mind that household savings in China are roughly 30 to 35% of GDP. That means that every year, households are putting aside in savings the equivalent of $5 or $6 trillion. $5 or $6 trillion. Where does that go? Property? No. Yesterday's story. Stock market? Some may be. I mean, our stock markets have been rising and rising and rising. Shanghai did absolutely nothing, but it sort of doubled recently. So there might be a little bit of it going in there. The answer is that the majority of that has been going into bank deposits because banks have been quite constructive, if you like, in terms of helping savings in an environment of declining interest rates, because the People's Bank of China has been lowering its reference rates quite severely. But all these banks offer at the same time gold accumulation accounts. So you can, as a household saver, if you like, housewife, whatever, you can tell the bank, I want to move 500 yuan a month into a gold accumulation plan. There's an awful lot going into these gold accumulation plans. Now, the reason that you don't really see this is that the gold that backs this doesn't leave the Shanghai Gold Exchange vaults. It remains within the system. The way the vaulting system works is that anything that comes out of the vaults, if it goes back into the vaults, it has to be recast to guarantee the purity of all the gold in the vaults. So there is absolutely, there is a disincentive, if you like, for the large Chinese banks to take gold out of those vaults. So they will back their gold accumulation plans by holding physical gold in the vaults. Now, I don't know whether they run a completely covered position. Probably not. I don't know. In other words, there might be an element, if you like, of unallocated, like it doesn't exist, backing these vaults. I mean, obviously it's unallocated because, there's a huge great lump of gold in the vault here, backing accounts here. But we don't know that they're 100% backed. But you can see that there is a squeeze developing through, if you like, household demand, nothing else. And I think what goes on in futures markets and all the rest is just noise. It really is. Just think, $5 to $6 trillion equivalent. Got to find a home. And where else does it go? And that's why you've got to drift. I mean, gold is, you want gold in size, forget it. You're not going to get it. It's all gone. It's all sort of pre-demanded. You join the queue. And the same is true in silver. That's been happening as well. And again, we're talking about, in the case of silver and gold, but it's probably more pertinent in silver in a sense. You've got 1.5 billion Indians, you've got 1.5 billion Chinese. 3 billion souls. Admittedly, some of them women children rather than women, some of them children. So, but you can see that the scale of potential demand here is just so enormous. It's not surprising. There's none left over. So don't be late at the party. If you're getting out of credit, don't look gift houses and the horses in the mouth, such as banks trying to knock the price so that they can close their short positions. They're trying to buy they're trying to buy gold off you, basically. So you have to ask yourself, why do they want my gold?
During the interview, Alasdair Macleod says the current geopolitical tensions resemble a broader proxy conflict involving major global powers. He explains that markets are underestimating the inflationary consequences, warning that rising prices will significantly erode currency purchasing power. Macleod mentions that as inflation accelerates, investors will demand higher returns to hold weakening currencies. but since most major currencies face similar pressures, confidence in fiat systems broadly is at risk. He further expresses that global markets, particularly equities, are beginning to lose momentum, with Japan acting as a key warning signal due to its role in global capital flows. This environment is pushing institutions away from paper assets and toward real money, emphasizing that gold is increasingly being recognized as the ultimate store of value. He notes that declining futures market participation and rising physical demand, especially from China, signal a structural shift away from paper markets. Based on this analysis, the ongoing crisis is accelerating the breakdown of the fiat currency system, with gold and silver set to play a much larger role in the global financial order moving forward. Let's jump into the interview.
It's clear to me that you could say this is almost a proxy war between China and Russia on the one hand and America on the other, with Iran basically fulfilling the role of a successful Ukraine. And America will be driven out of that, there's no doubt. The consequences of this are that this is not going to end very quickly. I would say that for most of this year, Hormuz will be shut. I think that's got to be your working assumption. The consequences for prices are being underestimated. I mean, I'm just drafting an article on this, which I'll publish later on today on my Substack. But the IMF thinks that in the US, inflation will rise to 4%, CPI, but core inflation won't go above 3%. What? Yeah, this is, I think this is a measure, if you like, of where intellectually, the sort of the investment banks, the strategists, the investment strategists and the economists, that's where they are at the moment. And they're having to rethink this. And the consequences, obviously, are very, very negative for currencies, because what we're talking about, what is inflation? If you're talking about inflation of prices, actually, it's loss of purchasing power of the currency. And it's that people, foreigners initially, will be looking for recompense for. If you're going to continue to hold dollars and its purchasing power is going down, then you're going to need a higher yield on your bonds or your deposits, or better returns on your equities, or whatever it is. Without that, you sell the currency down. But the problem is, what do you sell it for? Because all other currencies, all the G7 currencies anyway, are in the same boat. So you've got this sort of slightly unreal situation where everything is crashing except markets. But that will come, and I think that's going to happen, I think, in the coming weeks. I mean, you've already seen, for example, look at the Japanese stock market. That definitely is on the way down. I mean, you could argue how far down it'll go. That's not the point. But the point is that it's lost its upward momentum. And once it's lost its upward momentum, we're talking about the very minimum, a fairly significant correction. Other markets will follow, because Japan is the major exporter of capital to G7 nations, including America. I mean, in two ways. First of all, directly through its insurance companies and pension funds investing for higher returns. And also because the Bank of Japan suppresses interest rates. Their reference rate at the moment is 0.75%. And that's the highest it's been for 30 years. The carry trade on the back of this is enormous. It's just built up and built up and built up over time. So what we're looking at is Japan actually is sort of pulling the blanket up, like that, out of the whole system. And the whole system is going to collapse, in effect. That's the risk. And I don't see anyone really understanding this consequences. And so what, I've just asked a question, what currency do you get out of? Do you go into? Well, I mean, there's only one answer for that, and that is that as a foreign investor, foreign holder, whatever, of, say, US assets or British assets or whatever, you go back to your own currency, because that for you is your risk-free position, because you account in your own currency, if you see what I mean. The only other thing is that the value of these currencies will be reflected in their exchange rate with real legal money, which is only gold. Silver maybe as well, but particularly gold. And I think that what we've seen is we have seen the banks, the big investment banks, that actually realize this, though they won't admit it, are moving in that direction. I mean, they're making forecasts for gold. Goldman Sachs saying $5,500 at the end of this year. I mean, that's like saying Goldman Sachs is saying it's going up. I mean, they don't produce forecasts like, we think it's going to go to $10,000. They don't say things like that. I mean, don't accept any forecast as being the truth, if you like, in terms of what the forecaster actually thinks. But the fact that all these banks at the last LBMA meeting, I think it was in Korea in October-ish, September, I can't remember. Anyway, last year, again, the consensus was for higher gold prices. The establishment knows that the gold price is going up. They don't necessarily understand that it's because the dollar is going down and gold is relatively stable. It's the dollar that's going down. It's other currencies going down. But they know in which direction this is going. And so what we've seen on COMEX is we have seen open interest in gold fall. And it's fallen to the lowest level for over 15 years. It's something like 390, no, 300, I think it's got down to 368,000 contracts. This is the lowest level for 15 years. Silver is already at the lowest level in terms of open interest on COMEX, the lowest level for over 20 years. In other words, this is the system getting out of paper. Silver is a huge, great problem because everybody's short of the stuff and they can't really get out of it, say. Gold, in theory anyway, is slightly less of a problem because while they're short on COMEX, they're long in London. At least that's always the assumption. And I think that was probably the assumption. I think that's probably true when, the LBMA's straw poll came up with forecasts, above the then price. In other words, everybody was basically net long across the market. But China is sucking gold out of the world. It really is. I mean, the banks are finding huge retail demand, which is continuing despite the markdown in prices. I mean, I think the markdown in prices was, if you like, some sort of combined attempt to try and really shake out the bullishness out of the system. But China is a huge, huge saver. And I mean, I think coming back to your point, the thing that's changed for me is that this Iran war and the mess that the Americans and Israelis are making of this, and in Israel's case, the mess they're making of themselves, basically tells me that the end of the fiat currency system is being hurried along. It's going to happen a lot sooner than we might otherwise have thought.
The precious metals surge is being driven by a powerful mix of geopolitical tension, inflation fears, and aggressive safe haven buying. Investors are rapidly shifting capital away from equities and into assets like gold and silver as uncertainty deepens across global markets. As confidence in traditional currencies erodes, gold and silver are positioning them at the center of a potential monetary reset. Regarding this accelerating shift toward hard assets, could gold and silver ultimately redefine the global financial system as trust in fiat currencies continues to weaken? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.